put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The $100 billion Vanishing Act. In the heart of America, there exists a fortune so vast it defies comprehension, a wealth machine that generates more money in a single hour than most families will see in 10 lifetimes. Yet when the tax collectors come knocking, this empire somehow becomes invisible. The Walton family, heirs to the Walmart throne, controls over $250 billion in wealth. But here's what keeps Treasury officials awake at night. They've engineered a financial labyrinth so sophisticated, so perfectly legal, yet morally hollow, that billions of dollars simply evaporate before the government ever sees a dime. This is not a story about tax evasion. This is something far more unsettling. A tale of how America's wealthiest dynasty weaponized the tax code itself, turning the very laws designed to collect revenue into instruments of wealth preservation. And the most chilling part, every move is perfectly legal. The year was 1953, when Sam Walton opened his first variety store in Newport, Arkansas, a humble beginning for what would become the largest private fortune in American history. But Sam Walton wasn't just building a retail empire. He was constructing something far more enduring, a wealth preservation system that would outlive him by generations. By the time of his death in 1992, Walton had already set in motion a financial structure so intricate that even his grave couldn't stop the money from flowing to his heirs, untouched by the taxes that burden ordinary Americans. The Walmart founder died with a personal fortune of $25 billion. Today, his children control 10 times that amount, and the government's share, a fraction of what it should be. The Walton family doesn't hide their wealth, they hide the taxation of it. At the center of their strategy lies a financial instrument that sounds innocent enough, the family limited partnership. But in the hands of billionaire dynasties, this becomes something else entirely. A wealth cloaking device that makes assets disappear from tax authorities while remaining firmly in family control. Here's how the dark magic works. The Waltons place their Walmart shares, worth tens of billions, into family partnerships. Then they gift small portions of these partnerships to their children and grandchildren each year. But here's where it gets sinister. Because these partnership shares aren't publicly traded, the Waltons can claim they're worth less than the actual Walmart stock they contain. Sometimes 40% less, sometimes more. The technical term is valuation discount. The practical result: billions in wealth transfer from one generation to the next, with the IRS only taxing a fraction of the true value. Between 2001 and 2013, regulatory filings reveal that the Walton family transferred more than $13 billion in wealth using these structures. But the real number, the number that includes all the private trusts and partnerships hidden from public view, is likely 3 or 4 times higher. Investment analysts who've studied the Walton empire estimate that through strategic use of these valuation discounts and generation-skipping trusts, the family has avoided somewhere between $3 billion and $5 billion in estate taxes over the past 2 decades alone. That's not speculation. That's the conservative estimate. The actual figure could be twice as high. But the family limited partnerships are just the visible layer of a much deeper structure. Beneath them lies something even more impenetrable, a web of charitable trusts that serve a dual purpose. The Walton Family Foundation, established in 1987, holds billions in assets. On paper, it exists to support education reform and environmental conservation. In practice, it serves as a tax-advantaged warehouse for family wealth. Here's the alchemy. When the Waltons donate Walmart shares to their foundation, they receive an immediate tax deduction for the full market value. The foundation then never pays capital gains tax on those shares, even as they appreciate in value. And while the foundation is required to distribute 5% of its assets annually for charitable purposes, the other 95% continues growing, tax-free, in perpetuity. Even more striking, family members serve on the foundation board, deciding where millions flow, maintaining influence over wealth that technically no longer belongs to them. It's control without ownership, influence without taxation. Then there are the trusts, layer upon layer of legal entities designed to make wealth untraceable. The Waltons pioneered the use of something called Jackie O trusts, officially known as grantor retained annuity trusts, or GRATs, named after Jacqueline Kennedy Onassis, who used one to pass wealth to her children. These instruments are devastatingly effective. Here's the mechanism. A Walton places Walmart shares into a GRAT, which then pays them back a fixed amount each year. If the stock appreciates faster than the IRS assumed interest rate, which it almost always does, the excess growth passes to heirs completely tax-free. In 2013 alone, Jim Walton, Sam's youngest son, used GRATs to move $9 billion in wealth. The estate tax bill on that transfer, $0. But perhaps the most disturbing revelation lies in how the Waltons exploit something called conservation easements, a tax strategy that transforms environmental goodwill into wealth preservation. The family owns tens of thousands of acres across multiple states. By placing restrictions on how this land can be developed, promising, for instance, that a Colorado ranch will never become a shopping mall, they receive massive tax deductions based on the theoretical development value they've surrendered. One Walton conservation easement in Texas generated a $25 million tax deduction. Another in Wyoming, $30 million. The land remains in family hands, often still used for private ranching or recreation, but the tax benefits flow immediately. IRS auditors have become increasingly suspicious of inflated easement valuations, but the Waltons can afford the best environmental appraisers and tax attorneys in America, experts who know exactly how to value the surrender of development rights that the family never intended to exercise anyway. Now here's where the story takes a darker turn, where the full scope of the invisible empire comes into focus. In 2003, while the Walton family was moving billions through trusts and partnerships, they quietly established a family office in Bentonville, Arkansas, called Walton Enterprises, LLC. This isn't just a wealth management firm. It's a private financial command center, employing dozens of the world's most sophisticated tax attorneys, accountants, and wealth strategists. Former employees describe it as operating like an intelligence agency. Obsessively private, ruthlessly efficient, focused entirely on one mission: ensuring that Walton wealth compounds across generations while minimizing every possible tax obligation. The family office coordinates hundreds of entities, trusts, partnerships, LLCs, foundations, each one a node in a network so complex that even if the IRS wanted to audit it, they'd need years and an army of specialized agents to unravel just a fraction of the structure. And here's the most chilling part: they've had decades to perfect it. Internal documents that surfaced during a 2013 Bloomberg investigation revealed something stunning. Sam Walton began architecting this system in the early 1950s, nearly 40 years before his death. While building Walmart, he was simultaneously constructing a parallel empire, one designed not to sell goods, but to preserve wealth. He established his first family partnership in 1953. The same year, he opened his first store. He created trusts for his children in the 1960s, long before Walmart went public. by the time the company became a retail juggernaut. The wealth protection architecture was already decades old, battle-tested, and virtually impenetrable. Sam Walton once said, "The goal has always been to own a company that will be here 100 years from now." But he wasn't just talking about Walmart. He was talking about the fortune itself, engineered to survive intact, passing from generation to generation, forever shielded from the taxes that were supposed to prevent exactly this kind of dynastic wealth accumulation. The numbers tell a story of two Americas. The Walton family's collective wealth now exceeds $250 billion. That's more than the bottom 40% of American families combined. Walmart employs 1.6 million Americans, making it the nation's largest private employer. Yet a 2020 Government Accountability Office study found that Walmart workers are among the largest recipients of food stamps and Medicaid in multiple states. In other words, taxpayers subsidize Walmart's workforce, while the Walton family uses every legal tool available to minimize their own tax burden. The family's annual dividend income from Walmart alone exceeds $3 billion. The federal tax rate they likely pay on those dividends, after deductions and strategic planning. Industry experts estimate somewhere between 15% and 20%, lower than what a nurse or teacher pays on ordinary income. And that's before the wealth transfer strategies kick in, which allow billions to move to the next generation at even lower effective rates. But the Waltons aren't breaking any laws. That's the most unsettling truth of all. Every structure they use, the family partnerships, the GRATs, the charitable foundations, the conservation easements, exists because Congress put them in the tax code. The question that haunts policy experts isn't whether the Waltons are cheating. It's whether the system itself has been captured by the very wealth it was meant to regulate. The estate tax, originally designed in 1916 to prevent the emergence of a permanent aristocracy, has been systematically weakened over the past century. In 1976, it applied to estates worth more than $60,000 and had a top rate of 70%. Today, it only applies to estates exceeding $13 million, and the top rate is 40%. But even that 40% is theoretical. Ultra-wealthy families like the Waltons rarely pay anything close to it. Through the aggressive use of trusts and valuation strategies, their effective estate tax rate approaches 0. And here's where the story reaches its darkest revelation, the one that connects all these threads into a disturbing pattern. The Waltons don't just avoid taxes. They've actively shaped the tax code to ensure their strategies remain legal. Between 2012 and 2022, the Walton Family Foundation and various Walton-controlled entities spent over $50 million on lobbying efforts. Much of that money flowed toward protecting the specific provisions in the tax code that enable their wealth transfer strategies. When Congress has attempted to close the GRAT loophole, Walmart's lobbying arm has quietly pushed back. When proposals emerged to limit valuation discounts on family partnerships, industry groups funded in part by Walton Wealth mobilize opposition. The family has even funded academic research at major universities, research that just happens to argue against estate tax reform and in favor of the very mechanisms they use to preserve their fortune. This is regulatory capture at its most elegant. The wealthiest Americans don't break the rules. They write them. Former IRS attorneys describe a troubling asymmetry. When the agency tries to audit ultra-high-net-worth families like the Waltons, they face armies of elite tax lawyers from firms like Greenberg, Traurig, and Cravath, Swain and Moore, attorneys who bill $1,500 per hour and can drag audits out for years. The IRS, meanwhile, has seen its enforcement budget slashed by 20% over the past decade. The agency's own data shows that millionaires are now less likely to be audited than families making $20,000 a year, claiming the Earned Income Tax Credit. It's not that the law can't touch the Waltons. It's that the machinery of enforcement has been systematically dismantled, while the machinery of wealth preservation has been refined to perfection. One former Treasury official put it bluntly: the Waltons have weaponized complexity. They've made their financial structure so labyrinthine that the cost of auditing them exceeds what the government could realistically recover. They've made themselves too expensive to tax. The human cost of this system rarely makes headlines, but it echoes through every Walmart store across America. While the family perfects its tax avoidance, Walmart workers earn an average of $14.76 per hour. A full-time employee working 40 hours a week, 52 weeks a year, makes roughly $30,700 before taxes. Meanwhile, each Walton heir sees their wealth increase by approximately $70,000 per hour. Every hour, around the clock, whether they're awake or asleep. The disconnect isn't just economic, it's existential. The Walmart business model, brilliant in its efficiency, extracts maximum value from low-wage labor and passes those profits to shareholders who have engineered their own tax obligations into near invisibility. The system feeds itself. Retail dominance generates cash. Cash flows to the family through dividends. Dividends move through tax-advantaged structures, and the resulting wealth compounds tax-free across generations. Meanwhile, the workers who make it all possible qualify for government assistance that comes from taxes. The Waltons have found sophisticated ways not to pay. In 2015, something unusual happened. A crack in the armor appeared. The IRS challenged the Walton family on a specific valuation discount they'd claimed on a $2 billion trust transfer. The case went to tax court. For 3 years, lawyers battled over arcane questions of partnership valuation and minority discount calculations. In the end, the Waltons prevailed on most counts, but the court did find that they'd been overly aggressive on certain valuations. The adjustment, roughly $40 million in additional taxes. It sounds like a victory for the government, until you realize that $40 million represents about 6 hours of wealth accumulation for the Walton family. By the time the case concluded, their fortune had grown by more than $20 billion. The tax adjustment was a rounding error. The message was clear. Even when caught pushing boundaries, the downside is negligible compared to the upside of decades of aggressive tax planning. Today, the 4th generation of Waltons is coming of age, and the machine keeps churning. Sam Walton's grandchildren, names like Stuart, Tom, Alice, and Lucas, are already embedded in the family office structure, learning the same dark arts of wealth preservation their parents and grandparents mastered. New trusts are being established, new partnerships formed, new foundations funded. The architecture of invisibility is being reconstructed for another generation, ensuring that wealth which began accumulating in the 1960s will still be shielded from taxation in the 2060s. Estate planning experts who've studied the Walton structure estimate that if current laws remain unchanged, the family could transfer another $100 billion to the 5th generation, Sam Walton's great-grandchildren, while paying less than 5% in transfer taxes. For context, an ordinary American leaving a $15 million estate to their children would face a 40% estate tax on everything above the exemption amount. The Waltons, with a $250 billion fortune, have engineered an effective rate 20 times lower. The philosophical question at the heart of this story is uncomfortable. At what point does tax planning become something darker? The Waltons would argue, and their attorneys certainly do, that they're simply using tools available to any American. Technically true. Anyone can establish a family partnership or a charitable foundation, but there's a profound difference between having access to a tool and being able to wield it effectively. A middle-class family might be able to set up a GRAT, but they don't have $10 billion in appreciating stock to put into it. They can't hire teams of specialists to orchestrate hundreds of interconnected entities. They can't afford to fight the IRS in tax court for years. The system is theoretically neutral, but practically designed for those who already have. It's a locked door that looks open from the outside, but requires keys only the wealthy can afford. Some observers argue that the Waltons are actually providing a perverse public service by exposing the absurdity of the American tax system. Every dollar they legally avoid paying is a dollar that reveals how completely the tax code has been hollowed out. The estate tax, once a meaningful check on dynastic wealth, now functions more as a voluntary contribution that sophisticated families have learned to decline. The corporate tax system that should capture some of Walmart's enormous profits has been arbitraged into irrelevance through offshore structures and strategic deductions. Even the simple dividend tax has been minimized through timing strategies and basis step-ups that most accountants couldn't explain without a whiteboard. The Walton fortune isn't just large, it's a monument to the gap between the tax code as written and the tax code as experienced by those who can afford to reshape it. Yet here's what keeps emerging in conversations with tax policy experts: a quiet sense of inevitability. They describe the Walton structure not with outrage, but with grim admiration for its technical sophistication. It's almost beautiful, one former Treasury Department economist admitted. Morally bankrupt, but intellectually stunning. They've turned the entire tax system into a game they cannot lose. The feeling isn't that reform is impossible. It's that the will to reform has been captured alongside the system itself. The politicians who could close these loopholes depend on donations from billionaire dynasties. The accountants and lawyers who could expose the strategies profit from perpetuating them. Even the media coverage tends toward technical explanations that numb public outrage rather than channeling it. The Waltons have achieved something remarkable. They've made their own tax avoidance boring. Too complex to explain in a soundbite. Too technical to generate sustained public anger. Too embedded in the system to extract without dismantling the whole architecture of wealth preservation that benefits thousands of lesser fortunes. In the end, the secret wealth of the Walton family isn't really secret at all. The trusts are filed with regulators. The foundations publish annual reports. The tax strategies are discussed in industry journals. Everything is hidden in plain sight, protected not by secrecy, but by complexity and legitimacy. The Waltons have mastered the art of making their fortune invisible without ever hiding it. A disappearing act performed in broad daylight, sanctioned by law, enabled by Congress, and sustained by a political system that treats the preservation of dynastic wealth as a higher priority than the funding of public goods. Sam Walton built an empire that transformed American retail and created unprecedented value for customers and shareholders. But the parallel empire he built, the invisible one, the one that exists in trust documents and partnership agreements and foundation bylaws, may prove even more enduring. Because while Walmart stores can close and retail empires can fade, a well-constructed tax strategy can preserve wealth literally forever. The Walton fortune grows by approximately $1.8 million every hour. The federal government's share of that growth. After all, the partnerships and trusts and foundations and easements and discounts have done their work. Less than you'd think. Far less than you'd think. And as you read this, somewhere in Bentonville, Arkansas, attorneys and accountants are already designing the structures that will shield the next $100 billion. The machine never stops. The wealth never sleeps. And the taxes never quite arrive. That's the real secret of the Walton Empire. They didn't just build the biggest retail business in history. They built something far more valuable, a system that ensures their descendants will remain among America's wealthiest families long after the last Walmart store has closed its doors. A dynasty engineered to outlast the nation itself. And every single piece of it is perfectly legal. Subscribe and listen to our next story below.